fresh economic data could be giving the Fed more reasons to delay interest rate cuts. The unemployment rate ticked up slightly in February to 3.9%, but still remains at a historically low level in general here. That jobs report was followed up by two hotter than expected inflation prints, consumer prices and producer prices both ticking higher in February. Recent data, it's causing investors to pull back on Fed rate cut bets. Our next guest recently adjusted his expectations for the Federal Reserve. Joining us now, we've got Blake Gwinn here live in living color, RBC Capital Markets, head of U.S. rates strategy here. We're trying to toss around and just make sense of coming into this year, the commentary was around 6 to 7 cuts maybe, and now we're sitting at what, like 0 to 3 cuts maybe? So what from your purview has changed so significantly, and what does this mean for the potential amount of cuts?
Yeah, and to be fair, we thought the pricing kind of at the end of the year and into January was probably a little excessive. I think markets got a little ahead of themselves with some comments out of Waller and Powell. I think those were overinterpreted to think that cuts were coming. I think they were just kind of hinting that the conversation was changing towards cuts. They weren't saying, hey, we are asked to do this by March. We've seen the cutting cycles kicking off in June. We still see it kicking off in June. So I think the data that we've gotten hasn't necessarily pushed that back. Where we've seen the change is really in the pace that they're going to go afterwards. I think the improvement that we've already seen on the inflation side of the picture is enough to give the Fed some reason to start pulling back on rates, particularly when you think of things from a real rate perspective, just given inflation has fallen. Those real rates are tighter just because the inflation component has gone down. So I think that's enough for them to start the process. But when you have labor market data and growth data so resilient, I think it really takes away the urgency to move rates more quickly. So that's why we've gone from that 5-cut scenario where they were cutting every meeting after June to every other meeting where it's really just 3.
So what does that then tell us just about the action that we're likely going to see within the bond market? Because taking a look at the massive sell-off that we got yesterday, yields spiking higher, is there much more room then to the upside, do you think, for yields?
I think we're pretty well priced, to be honest. I mean, I still probably am biased towards that short position. I think, just talking to investors, I was on the West Coast earlier this week and talking to a lot of investors out there, and I still think there's a desire to lean long into the market. So I think a lot of them are positioned long, and I think if we see 10-year yield back up to that kind of 430, 450 type of range, there are people there that will support that market. And also, I just think overall we're in a pretty good place as far as Fed pricing. So you always do have to think about the balance of risks around the Fed pricing. It's never really that you can look at Fed pricing and say that's exactly what markets are expecting. They're always going to be pricing in some risk of a greater slowdown that's going to kind of keep those yields from rising too much, in my view.
And so as we think about whether or not, the number of cuts, given that the estimate has changed now significantly from the start of the year, does that mean that we've seen the Fed, or should believe the Fed has been able to pull off a soft landing here?
I think the soft landing is consensus. I mean, we see the soft landing. I think the real question for us, and to be honest with you, when we changed our Fed call, I think there was more interest in how we changed our 2025 figure than actually our 2024 figure.
Where's the 2025 figure?
So we now only have 2 cuts in 24. We're kind of leaning towards, I think, this kind of 94 to 98 type of situation where the markets really did kind of move sideways for a very long time. The Fed cut 75 basis points, just to be cautious, several times during that span. But they would cut 75 and then stay put for quite a while after that to see how things went. I think we could see something similar this time around. So I think there's been actually more interest in that kind of side of things, how it's shaping up in 25, and whether those risks are really, could there be a reacceleration? Could there be another leg of an expansion in 25, or are we going to see more downside risk there? I think there's almost more interest coming in 25 now where that terminal rate is.
Like a very short-term question here, but with the Fed meeting next week, we're going to be hearing from Powell. What do you expect, I guess, given the tone that we could hear and what the reaction is going to be within the bond market?
So I think everybody's focused on the dots, how many cuts we're going to show. That's been all the conversations that I've had over the last week around the FOMC meeting. They did show 3 cuts in the December SEP. That's the median dot, was at 3 cuts. There were only 2. It only takes 2 people that were on that median dot to move their estimate to pull the median up. So that median's not very well protected. It could move very, very easily. I actually lean towards them moving that to 2 cuts, which I think is a little out of consensus. I think consensus is generally right now for that to stay the same. A lot of the comments we got in between the January and February CPI data, they seem to be kind of writing off the strength in the January CPI data and saying, hey, there's going to be bumps along the way. We're still fine. 3 cuts still probably the best guess of where we're going. I think they might have been hoping for some relief in the February CPI data. It did not provide it. There was no. I really don't think it provided evidence that we can write off January as idiosyncratic or kind of a one-off. So I think they're left with two inflation prints that really don't give them the confidence that they wanted to see. And I think because of that, we only need two people to move, and I think that inflation data is going to be enough to tip two of those dots, and we're going to see that median move to two. In which case, I think the markets would react to that relatively hawkishly.
And some of the inflation data that the Fed is evaluating, and especially in the stickiest parts of inflation, you think about the services and specifically within shelter costs and perhaps energy, areas where the Fed doesn't necessarily have a lever to pull or control, at least most immediately here. Should they be over-indexing in other areas of the data that they're evaluating then?
Yeah, so when I talk about the February data, it wasn't that the headline print was necessarily out of consensus. It was really some of those components. And when you start looking at how the print, looked on some of these various subcomponents, for one, we did see the diffusion index still going up. So it just means the number of categories that are seeing some type of inflation is still going up. So it's broadening out. The other thing is the super core, as they call it, which is that services X housing. And it did come back from that very, very high print in January, but it's still at a very elevated level. So I think that is something that at least gives the Fed a little bit of pause. We always kind of knew that goods prices were going to start, the disinflation that we were seeing there was going to start slowing. That drove a lot of what we got in 2023. And the Fed kind of understood, markets understood that that's going to slow down, and really the other side, services, is going to have to start picking up and giving us more of that disinflationary pressure. And the prints we've gotten in the first 2 months of this year really did not show us that that's happening.